Hi, Ingo. No
How's-
technical difficulties, hopefully, today.
Today's good. How was your week otherwise?
That was good. Pretty busy, but I think that's always a good thing. Ready for the weekend and looking forward to this webinar, of course, which should be quite interesting. I think, is this the first one we have with our new design, or is it already the second one, Ingo?
No, it might even be the third one, but I added a few surprise slides, so you haven't seen them before.
Oh wow, that's the suspense is real. Looking forward to it. Okay. Yeah, maybe while people are just kind of dialing in, I'll start with the general intro part. Today, obviously, we have our webinar on the history and future of revenue growth management. It's supposed to look kind of back on where revenue growth management came from, what the aims were, and how they've developed over time. And also, of course, what the future brings, and yeah, some interesting anecdotes and insights along the way. But I think, Ingo, we have a quick introduction of Buynomics, so just wanted to get that out of the way. Basically today we have our host, as usual, Ingo Reinhardt, co-founder of Buynomics. More than 13 years experience in pricing and revenue management, and also developed our unique approach to RGM. And I'm Paul, I'm head of sales, so I'm the first person to speak to in case you're interested in working with us. If you go to the next page, Ingo, we have, I think, another bit of general info about what we're doing. We obviously a software provider and aim to make your revenue growth management better and faster. There's basically a novel approach at the core of all of this, and better outcomes across accuracy, insights, and profitability. So if you want to learn more, let me know in the chat or by email. I think, do we have one more intro slide, Ingo, or are we diving?
No, I think this should be it.
Mm-hmm. Perfect. Then maybe just as a heads up for everyone, I see participants are trickling in. You can ask any questions in the chat or the Q&A for this session. Raise your hand if you want to, to add something to the conversation. I'll be moderating a little bit in the chat. I'll answer some questions live in the Q&A if I can, and in the end, I'll pose the remaining questions to Ingo, and we can have a bit of a Q&A, hopefully in the last 5 minutes or so. So yeah, encourage you to join, and I'll hand over to you, Ingo, to talk
for this introduction. And I'm happy to talk about this topic. Let's get started as you usually do. So we're talking about revenue growth management. I think there are a number of similar terms. There's revenue growth management. There's also revenue management. And I think it makes sense to start with a general definition. And as we're talking about history and then also future, we, as many others did with similar topics, asked ChatGPT, what is revenue growth management? I think the definition that it provides is pretty good, actually, and well structured. So I'll just quickly read it, and then we'll take it from there. So what ChatGPT answered to the question, what is revenue growth management, is that revenue growth management is the process of identifying and implementing strategies to increase a company's revenue. Sounds good. This can include tactics such as expanding into new markets, increasing pricing, providing sales and marketing efforts, and launching new products or services. It involves analyzing data, identifying trends and opportunities, and making decisions that will drive revenue growth. The goal of revenue growth management is to maximize the company's financial performance and increase its overall revenue. I think overall, probably most of us wouldn't disagree. If you do, please write it into the chat. I'm happy to discuss at the end. But in general, this captures the general idea of what we're doing. It involves different different measures and departments in the company, and we've put, I think, structured a bit more with the focus of what we think is most important on the right side here. So I think the core is in some sense to optimize profit and revenue depending on the strategy of the overall organization. So are you aiming for profit maximization? Are you aiming for revenue maximization, market share, whatever the overall objective of the company is? And what we think makes a lot of sense is to split it up, revenue growth management, into like an inner understanding, what we have here in the inner circle. And these involves all the things, the different measures that are close to the pricing and portfolio decision at the end. So typically the 4 or 5 levers of revenue growth management, which typically include price decisions, portfolio decisions. So things like your pack price architecture, what products to include in your portfolio, things like how to work with promotions. Do you have like a high-low strategy, for example? Or do you have a everyday low price strategy, and so on? And of course, also things like your trade term management is involved. And to make this happen, typically also other areas of the company are involved. Marketing, of course, has an effect. With good marketing, you can increase the perceived value of your product. You can enlarge the market. Things like M&A become relevant, or expansion if you think about entering new segments with your product and so on. So these things are all, from our point of view, relevant for revenue growth management. So everything that in the end affects profits and revenue of the organization, but we will focus here on more on the inner topics, and we identify these with the price, typically the 5 pricing levers, and we'll come back to that. So just to get started, we don't want to dig too deep into this part, but I think it is useful to get an understanding of the evolution, the history of the field. And typically, if we look essentially at the professionalization of revenue management there over the roughly past 100 years, we see that like the first efforts that entered the field were in with the introduction of like a professional marketing and sales promotion to increase sales that started somewhere around the 1920s and 30s. Then I would say the next big step was the introduction of a more professional market research in roughly the 50s and 60s that professionalized many of the market surveys that we use, including questions like things like conjoint studies and so on. And then I would say the next major step was somewhere in the 80s with the automation and much broader use of technology to make revenue growth management possible. I think would say a notable example is, for example, in the airline industry, which used technology to optimize the revenue, and we'll come to that example, I think, on the next slide. And what we think is, and this is also where we see ourselves, which is, I think, that the next major step in revenue growth management is now comes with the better use of advanced technologies, machine learning, artificial intelligence, the capability to assess very large data sets and integrate different data sets, integrate what we can learn, for example, from sales data, and integrate it also with different surveys, conjoint studies, and other studies to get a holistic understanding and be able now to actually optimize revenue growth management or optimize revenue across the different levers. So integrate price changes with portfolio decisions and a certain promotion strategy, for example. So we're now with the technology able to integrate all of these different things, and this is what we want to talk about here today. So to get started, let's start with a very simple example, because this is, I would say, really the starting point of pricing. So I think just a refresher, we all know this in the field. I would say that if you have, if we're living in a world with just a single product that we're selling, apples, for example, and we fully know the demand curve, we know how many units we sell at each price point, then pricing is very simple, right? So the price optimum is at the place where we have margin times price elasticity is -1. So for example, if our product costs 100 euros to make, our price elasticity is -2. then the profit optimal margin is 50% and the optimal price is 200. So in this simple world, there is no place really for revenue growth management. Revenue growth management, in our understanding, comes into play when it comes a bit more difficult and more complex, the world we live in, and complexity can come in different forms. So for example, if we don't just live in a world with a single product, apples, but we live in a world where there are many products, there are different sizes of apples, there are pears and other fruit and other products. So we have complexity, for example, in the number of products we're dealing with, as we do, for example, in consumer goods. This is the case. Another input that increases complexity comes, for example, from the case when we have limited capacity, as we do in aviation, hotel industry, and other cases. So when there's limited capacity, and we have, for example, coming in customers with different preferences, different willingness to pay at different times, that adds complexity and allows us to employ revenue management. Or we have variation in the willingness to pay over time. So we need for revenue management to have a place and not to be trivial. We need to have some sort of complexity, and there are different types of complexity that play a role and different ways of addressing these. And this is the case where we can go, and probably most of us have seen this comparison. In the previous case, if you act with a single price, there's on the previous slide, there was a single price optimum, I think 200 euros for the product that optimized the price if everyone has the same that gets the same price. But if we do have the option with many products to differentiate, so people have with a higher willingness to pay have the options to buy a best product, people with a lower willingness to pay have the option to buy a good product, and so on, or they come in at different prices, then we have the option to optimize the revenue and essentially aim to get closer to the maximum willingness to pay of every customer, giving different products, different time dynamics, and so on. So I would say this is the core idea when we talk about revenue growth management, is to get to use the complexity that we have in the market and use it to optimize the revenue or to optimize the profit, and we'll come to that distinction also in a minute. So because for historical reasons, because I think typically this is considered the beginning of revenue management or revenue growth management is in the aviation industry, where you have the specific situation that on each flight there is a limited capacity of seats that are available. And also historically, it's known that customers, of course, have different willingness to pay. And for example, in a very simplistic way, you can differentiate between business travelers and leisure or private travelers. And typically the business travelers are the ones with a higher willingness to pay, and historically they tend to book later. And the way that revenue growth management works in this place is that you have an evolution in the price over time. So the closer you get to the final flight day, the price changes, as we probably have all seen over time. And typically it goes like this. The idea is that you tend to, you have still the whole plane is empty and you're starting to book it. You typically start with a lower price in the beginning, and seats fill up because the people with the low willingness to pay tend to buy early. And what is then done, maybe on a daily basis or in certain time intervals, the market is assessed in the sense that how many seats are still available and what demand do we expect. So, and if, for example, the remaining demand is underestimated at an early point of time, you can reduce the price. If it was overestimated, if it was underestimated, you increase the price. If it was overestimated in the past, you would reduce the price. And this way, by always matching what expectations do you have about the demand in the remaining time versus how many seats are still there, you adjust the price over time. And typically the price of these flights goes up, but it might also go down if, for example, something happens, there was some event and the expected seats were not sold in a certain time period, that the price also goes down over time. And this, of course, is a complex game. You need to essentially integrate backwards with your expectation what will happen at the end, even while you're at the beginning of this process. Another example, also with limited capacity, but because for different reasons, is, for example, the fashion industry, where you have sort of seasonal effects. So you come out with a new collection at the beginning, and you have still the whole market to sell to, and you typically start with a very high price in the beginning, because the people with a high willingness to pay for seasonal fashion products, they tend to buy early. And then what happens is that the people with a high willingness to pay essentially drop out of the market for two reasons. Once, because they've already bought the product or a competitor product, or because with seasonal fashion products, their willingness to pay decreases as you move through the season. So there, the challenge has a similar reason, that you have limited stock capacity in the end, and you want to maximize your revenue. And I mentioned this before, typically in pricing, we have to look at both profit and revenue, but if you have limited stock for fashion products, for example, or a limited number of seats in an airplane, the profit and revenue maximization are essentially the same, right? Because you have essentially no variable costs, right? Because it doesn't really matter if you to your costs, if you fill the plane all the way, or you fill it only partly. So optimizing revenue and optimizing profit is pretty much the same in these situations. And that's also historically why it's called revenue management or revenue growth management rather than profit management. Whereas in situations like consumer goods or many other industries where you have always variable costs, and maybe the question of capacity or stock limitations is less relevant, of course, the focus should typically tend more towards the profit optimization, because the profit optimum and the revenue optimum are not the same in this situation. Let's look at two examples from those where this is more relevant. One dynamic is that we see, I'm not sure if everyone is aware of that, but for example, here in Germany, the petrol prices, when you go to the gas station to fill up your car, they change massively. The prices change massively over time. And typically how this is, for example, here in Germany, is that in the morning, the prices start at a very high point, and then they drop over the whole day, and typically until the cheaper gas stations close down. And then the more branded, the Shells and so on, they increase their price again to a maximum price. And then the next day, the same game plays out again. So, and this essentially, and this is a large amplitude. It has, so here in Germany, I think gas prices per liter are somewhere around 160, 170, I would think at the moment. And the difference between morning and evening is somewhere around 10 to 15 cents. So this is really a major difference. And the idea really is that those who know this and who are price sensitive, they will fill up in the morning, whereas people who are not aware of that, they more or less randomly fill up over the day. And that allows the suppliers to introduce some sort of price differentiation between these segments. The people who are price sensitive and know about this, they fill up in the morning, and they fill up in the evening where the prices are low. And people who are not price sensitive, they fill up whenever. And this allows companies to on average achieve a higher price or a higher premium than they would if they had the same price all day long. And it works to some extent because the market has certainly to some extent organized around this principle. So almost all gas stations follow this pattern here. Another way where it's relevant is, for example, in consumer goods. I think from looking at who's participating, most of you will be familiar with this case, is when you work with promotions, this also introduces a way to differentiate your prices and address different target groups with different prices. So particularly when you introduce promotions, this allows you to also address customers with a lower willingness to pay, whereas the customers who are have a higher willingness to pay for your products they will also buy at the regular price, and these additional segments you can address then with the promotion. And of course, whether or not a promotion works depends very much on the specific dynamics of the promotions, what margin you have with and without a promotion, how much sales you gain with the promotion, how much you cannibalize your own products that are not promoted in a week, and so on. So the whole thing is fairly complex. And needs to be managed very tightly, particularly in cases where you have overall lower margins, so less margin for error in the steering here. So, but what I want to say is that just to recap the general principle here is that revenue management, revenue growth management makes sense in cases where there is some degree of complexity that allows for a differentiation using, for example, different products, different prices, and so on. And this need is particularly strong in cases, and that's also where it came from originally, where you have capacity constraints, where you're maximizing the revenue and maximizing profit is essentially the same because you have no real variable cost, because flying with a full plane or a half full plane is essentially cost the same to the company. All right, so focusing now a bit on the consumer industry, fast-moving consumer industry, we have, we mentioned it before, a larger number of levers that are important. So we have price decisions, we have pack architecture decisions, we have promotion decisions, trade terms, and so on. And we need to steer it across different channels typically. And this adds, I would say, much more complexity than the examples had that we showed previously. And what we noticed is that the tools that are available in the field that we frequently see, I'm sure most of you have heard of these, is, for example, cost plus pricing, where you just have a fixed margin on top of your products. Many companies work with sort of a competitive pricing, where you have a markup or markdown on your competitor prices. There is a lot of price elasticity measurement using typically regression-based models, which are very, very rough, and they typically used in a way that's not ideal. Typically, they are converted into a single price elasticity value, but particularly if you have a linear demand function, the price elasticity differs across the price range. Also, there's a lot of value pricing going on, where essentially the idea is to price products according to their value, and this is typically done using the different value drivers, the type of filling in this ski jacket example, and whether or not the jacket is waterproof. So you build up a price structure, and this is also reflected in things like pack price architecture, where the idea is you first identify what products you need across a relevant dimension, pack sizes, for example, and then price the product according to some value function across the pack sizes. Also, what we're seeing in increasing measure are behavioral ideas. So things like using price thresholds, using a good, better, best setup, where, for example, the different products have different functions. So the best sometimes has the function of increasing the willingness to pay, and then getting more people to buy the better rather than the good product. And the question is, of course, how does that work in a competitive environment where the influence of your own portfolio is somewhat limited compared to a case where you completely control the situation and people only can choose between your products. And of course, one of the core difficulties here is, how do you combine these different ideas? So for example, how do you combine value-based pricing or a pack price architecture with a price elasticity approach? From what I see frequently is that these give very, very different indications on how to price a product. Price elasticity might say, okay, you need to increase a product, but according to the pack price logic, you need to decrease it. So often very difficult to work with these. And I think spent the last 5 minutes on the future, where we think it is. And this is essentially the approach that we have, and that's underneath our technology. And it's essentially the virtual shopper technology. And the idea is that using different data sources like sales data, like survey data, everything that's available, we create what we call these virtual shoppers. They have preferences for different products. And essentially you can show your these virtual shoppers, your different products, also against competitor products. And each one of them will make a purchasing decision given the offer shown to that virtual shopper and the preferences of this virtual shopper. And these are derived from, for example, historical data. So they are able to replicate actual sales situations. And what then happens is that this allows you to have a very accurate understanding of how customers will react if you change something in your portfolio. If you, for example, change a price, if you introduce a certain promotion, or if you change something in the pack lineup. And of course, you can then use it to derive product-specific demand functions, revenue, profit, and everything. Essentially, this gives you complete transparency on what happens in a market given certain decisions that you make as a decision maker. And for example, with the limited time, just go quickly over these examples. What this allows you is to make, for example, very complex decisions. So for example, if you want to move from a high-low strategy where you have promotions in some weeks and no promotions in other weeks, which is indicated here by the units sold in the different weeks, you move from a high-low to an everyday low price. Even if, of course, with the everyday low price, there are still some ups and downs. They're much reduced, but there's still ups and downs because competitors are still working with a high-low strategy. And if a competitor has a promotion in a week, then you sell fewer products. And these types of effects can be understood with this virtual shopper technology, for example. And in the end, this allows you to gain complete transparency on what to do and gives you essentially the confidence to make decisions like moving from a high-low to an everyday low price. We do a demo. I'll skip this for now because I think we're close to the end of the half hour. But we're happy if you're interested. We have lots of material on that on our website. Please take a look there. So in the end, what I want to say is that with the technologies that are now available, and I think this is more towards the future of revenue growth management, it allows you to gain full transparency with, in our case, with the virtual shopper technology over the year, how your sales evolve, given, for example, different promotion strategies, what impact this has on your revenue, on your profit, market share, and so on. And it allows you to make really integrated decisions on your revenue growth management, where you can, for example, see maybe a certain pack size works better with a high-low strategy, or another pack size works better with an everyday low price. And you can essentially make decisions on all of these levers in an integrated way. And this allows companies, our customers, for example, to make much more profitable, or if you're aiming for revenue, much higher revenue decisions than with the traditional tools. And with that, I'll hand over to Paul.
Perfect. Thanks, Ingo, for that spot-on timing. I think there were not many questions during the presentation itself, so I think it's a good sign that there was no immediate question mark from your talk. But we have one here in the chat. I think it's a bit with it's a half-serious question. When is the best time to buy a flight? Basically referring to your anecdote about the airline industry. And you said something about basically the different cohorts of people buying and their willingness to pay. Do you want to elaborate on that?
Yeah, so I think typically it's early. I think there are websites that so reverse engineer the logic of the revenue management systems, and they tell you if you look at it, they tell you what the probability is that the price will go down again. So if that's what you're looking for, there's technologies that solve this issue.
Okay. And then someone is asking in the Q&A, what data inputs Buynomics requires to complete the analysis? You want to give a quick view on that?
Yeah, so very generally, essentially it's the same data that's used for also other pricing and revenue management questions. So we work, for example, with sales data. We work with transaction data. We can also integrate insights from surveys, conjoint, for example, or more specific surveys, for example, to identify price thresholds and other features. So essentially with the technology, and happy to, if you're interested, go into more details on that, is that we can integrate insights from different sources and combine them in a holistic or complete model that predicts customer reactions to, for example, price changes or pack architecture changes.
Mm-hmm. Great. Now the questions are rolling in. Next question is, how do you track the accuracy of the solution?
Over time, with different data coming in. So essentially makes a prediction, and then over time you get the real numbers, and these are compared then.
Perfect. Then someone else asked if there will be a recording, and yes, if you registered for this webinar, you will get a recording by email. So check your inbox around Monday, Tuesday, which is usually when we have this ready. And then someone is asking, how do you manage a large amount of competitors? How many competitors can you input in a predictive model?
Yeah, so typically the competitive environment really depends on the situation, typically there's, I don't know, there's in most cases 3, 4, 5 or 6 competitors, and typically you would have a couple dozen, or in some larger cases hundreds of products together that are alternatives to a customer, and this really what matters in these situations is what's the relevant size from a customer point of view. So when in many cases customers choose between, let's say, a few dozen products, this is what's been modeled. If customers really choose between hundreds of products, and that's what's been modeled.
Okay.
But of course, if you have 100 alternatives, the hundreds doesn't have that much of an impact anymore, right? So it's less than 100s, right? Because there's always in these cases a Pareto principle at work, that most interaction between alternatives is between a more limited number of alternatives.
Makes sense. Then one question is about the willingness to pay. How will it reflect the willingness? So how will the virtual shopper willingness to pay reflect the willingness to pay of the market? And then how does it take into consideration competitor price and promo movements? Pretty similar to your previous question.
So willingness to pay of the market and shoppers, that should be the same thing, right? The shoppers are the market. Essentially they have different preferences for different products. And for example, if a competitor decreases a price, if that happens, then of course that competitor's products become more attractive, and that pulls some of the demand from your product.
Mm-hmm. Okay, I think that's all the questions we have, actually. Quite a few, very interesting. Maybe just going to the next slide, Ingo, for everyone that's stuck around here. I want to highlight that we have our next webinar coming up in 2 weeks again at Friday, the 10th. Pricing and revenue management with AI and machine learning. So kind of that combination. I think AI, a super hot topic at the moment with the likes of ChatGPT. Even we have it in our, not only in our solution, but also in our presentation here with ChatGPT as the intro. So follow us on LinkedIn and check your email inbox for the invites, and we can see you there in 2 weeks.
Perfect. Thanks also from my side. Yeah, looking forward to the next one, and until then, have a great weekend. and see you next time.
Thanks, Ingo. Bye.